Hello and welcome to Econo Day Unplugged on Tuesday, the 3rd of March 2020. And it's certainly a super Tuesday for financial markets, so that's got nothing to do with the race to become the next US Democratic presidential candidate. Mark Pender is on the US West Coast, Brian Jackson is in Sydney, and I'm Jeremy Hawkins here in London. Well, to state the blindingly obvious, it's the escalating coronavirus epidemic currently affecting in excess of 90,000 people globally that continues to dominate investor behaviour and now more than ever dictate market prices. And in the wake of last week's carnage in stocks and the general shift to risk off, some monetary authorities, including the Fed earlier today, have already responded via liquidity injections and or lowering key interest rates. A raft of dovish official comments in recent days had previously prompted significant speculation that there might be a coordinated move on rates involving the Fed, Bank of England and the Bank of Japan as soon as tomorrow. As it is, the US has jumped the gun. G7 finance ministers and central bank governors also issued a joint statement earlier, promising to make use of all the necessary and monetary and fiscal tools needed to stabilise markets and protect growth. However, it was notably light on any details. Obviously, much will depend upon how the COVID-19 crisis evolves, but as a starting point, the key question here must be, would a broad-based reduction in borrowing costs work in the first place, or does the avoidance of a possible global recession now need a looser fiscal policy? Normally we kick off in the Southern Hemisphere with Brian, but in the light of the Fed's first intermediate move since the coordinated cuts back in 2008, if I remember rightly, over to you, Mr. Pender, for your thoughts on today's developments.
Well, I guess my first thought is the stock market's reaction and the bond market's reaction. Just a flood into the bond market, pushing rates far lower, well into record territory, and creating more of an inverted yield curve. We've lived with this inverted yield curve for at least a year, I guess, and it's been signaling a recession all along. It's been a surprise reaction in the stock market. We're down about 3% again today. And even after yesterday's 5% rally, it wasn't at the expense of the bond market. There was almost no change at all in the bond market. It's a bit of a mystery right now, and it makes you wonder if the markets are over-anticipating the virus's effects. Powell himself, said that the economic data so far hasn't shown any effect. This is going to be definitive, actual hard data. He did mention survey data and citing questions. We had the ISM earlier this week on Monday, and there was really hardly any effect on the numbers there. We had delivery times spike up, which is a positive in the way they calculate the composite. But the commentary was limited, but it definitely said that there was being havoc played on the supply chain in the manufacturing sector. Anyway, so Powell wasn't really able to cite any direct impact yet, and hinting also perhaps that their own contacts in the business community are pointing to possible effects. But I think it's definitely they're reacting more to the market and what it is telling them. Interestingly, Powell cited several times in his press conference today the dual mandate of the Fed, keeping high rates of employment and stable inflation. But that's not why they're reacting. They're not reacting to any change in employment, which is still very strong, and inflation hasn't changed at all. It's the third unsaid mandate that he literally didn't say, which was the stability of the financial markets, and that's leading them around, I guess, by the nose, so to speak. But I have a question for you, Jeremy. Is now you had said that the ECB, or did you say the ECB said the G7 has less of, seemed to have less of a details, or certainly the Fed really did show it is very serious with this 50 basis point cut. Is there less seriousness among the other central banks?
Well, I could almost turn this around and get Brian involved in this as well. I mean, I think looking at the market reaction we've seen today, it was quite interesting. You mentioned we had this huge rally come through in the stock market yesterday. In the midst of that, you had all this speculation we were going to see this coordinated cut coming through from the three big central banks. And we got, the Fed apparently has done its own thing and come out and cut 50 basis points. But I think also, inbuilt into the market was this knowledge that the G7, the group of finance ministers and central bank governors, were going to be issuing some kind of communique. And my personal view is I think we're at the stage now whereby investors as a whole are looking at central banks and thinking, well, okay, a cut in central bank interest rates would not be a bad thing in terms of helping to restore confidence. But we're not in the kind of credit crunch scenario that we were back in 2008 when we didn't have credit flows going through. This is a coronavirus. Cutting interest rates doesn't help to address the virus. And I think what they were hoping for from the G7 statement, which really, as you said, didn't say anything. It simply came out and said, we G7 people are going to come out and do what's necessary, monetary policy and fiscal policy, to make sure everything's okay. Well, okay, big deal. That's just nice words. But what about the action? And I think markets now want to see a coordination between monetary policy and perhaps even more importantly, fiscal policy, if we can see some kind of sustainable rally. Brian, what do you think about that kind of view? Because from your side of the world, from what I've seen, you've got central banks saying different things. Some central banks, like the RBA, cutting rates. Was it the Bank of Korea? And I think the RBNZ kind of intimating that there's not much point in using monetary policy. It should be fiscal policy. Is that right? Have I got that wrong?
No, I think that is right. And yeah, you are definitely seeing a bit of, some divergence in the messages coming out from central banks. But an increasing, trend towards supporting more fiscal moves. That's definitely the case here in Australia. The RBA cut this week, but a lot of talk about how the federal government needs to bring in, maybe targeted but still pretty substantial fiscal support for a lot of the businesses and sectors impacted by it. And in the case of Japan, it looks like Abe is also very much on board with the idea that it needs to do more on the fiscal front, given that Japanese monetary policy has been so accommodative for such a long time anyway. And I totally agree. I think, you have an economic crisis and you have a medical crisis, and the extent and the duration of the economic crisis is going to depend on the extent and duration of the medical crisis, and that's just an unknown, but it's not something that central banks are able to fix.
But Brian, I have a question. But you said economic crisis, Brian. I mean, we may be headed toward one, but there's no evidence that we're in one yet. Certainly, the numbers out of China were a disaster, but that's only 1 month, and they could snap back presumably. Should we think of this right now as is this a self-fulfilling prophecy when we talk about economic crises?
Well, I'm just using crisis as a way to describe a very disruptive effect. I'm not saying that it's necessarily going to be a long-lasting one, but I think just the scale of the slowdown in China and the potential that causes to supply chains right across the world, it's obviously a serious concern. And so, but we could have a very strong bounce back if the medical situation improves. So it's really just driven by whether authorities can get on top of it as a medical issue, I think.
Matt, I can't help wondering if we might have had a better response if we'd seen a higher degree of coordination. I mean, if we'd seen something coming out of the Fed and the Bank of England and the Bank of Japan all at the same time, and perhaps the Bank of Canada, I mean, they meet tomorrow, and I think now if they certainly don't come out and cut interest rates, the market's going to be hugely disappointed in Canadian assets. But I think we're at this stage now where investors want to see coordination between central banks. They want to see cooperation between the central banks and the fiscal policymakers, and these bland statements they're putting out at the moment they're all very well, but they've done you've talked the talk. The markets really want to see do the walk now.
But Jeremy, there's no structure for, at least here in the U.S., between coordinating central bank policy and with fiscal policy. They're very, very separate, and there's no hotline. Powell said today that they're talking with, he said, all the central banks. I know that's a lot of central banks, but are they talking with all the governments? Are they talking with the major lawmakers here in the U.S., let alone other places?
I think they are. I think they are, but you're right. The problem for the central bankers is that they have no say in fiscal policy. Now, the fiscal policy makers, to the extent that they may or may not be responsible for appointing central bank governors or perhaps even members of the Monetary Policy Committee, they perhaps can have some say in the future shape of monetary policy. But we have some comments coming out from Mark Carney, who is still just about the central bank governor for the UK at the moment. His term finishes in a couple of weeks' time. Intimating that there would be this cooperation between fiscal policy and monetary policy and be some kind of coordinated move. And I think markets just really want to see that. But you're probably right. It's just difficult at this stage to see if they got any kind of structure in place which actually allows that to come out and happen, because I think that's what's needed now. And I think for countries like the UK, and I might as well have a quick chat about the Eurozone, Eurozone in particular, I think if you want the big central banks to act in concert, you need the ECB to do something as well. Now, okay, we do have an ECB meeting next week, but to the extent that the Fed's is happy to move before its meeting, why couldn't the ECB do something? And at the end of the day, I think that comes down to the fact that one, they've got negative interest rates already. Their deposit rate is minus 0.5%. So why bother taking another half a percentage point or 25 basis points off that? Of course, they've got this split on the council as well, whereby an increasing number of governing council members believe that negative interest rates have been around for so long that they're starting to do more damage now to the workings of the financial system and by knock-on effects to the economy as a whole than if we actually saw perhaps the interest rates in positive numbers. So I think it is, as we've talked about on previous podcasts, one of the big issues and something which central banks must have been desperate to avoid is the fact that you get a potential big downturn at a time when interest rates basically are rock bottom anyway. The Fed perhaps can do a little bit more, but for a lot of other central banks, that's it. They've used interest rates, they've used quantitative easing, they can go out and buy more assets, but will it really make any more difference? ECB, as mentioned, I think they do have some big problems. I think the markets in some ways are quite like them to see them do something, but by the same token, they didn't really expect anything. And it's been interesting looking across the major people on the central bank boards, notably by her quietness has been the ECB President Christine Lagarde. Now, she did have the Vice President saying yesterday that the frontline response should be fiscal policy, not monetary policy. And again, that's really consistent, I think, with what we've seen coming out of the ECB for some time, trying to lean upon European governments to come out and reflate. Now, the problem for the European governments, of course, is that they've got this Growth and Stability Pact, which essentially limits the amount that they can actually come out and borrow in the first place. Now, I think a key date looking ahead for financial markets on that basis will be March the 16th, when, as I understand it, there's going to be a meeting of the Euro finance ministers, all 19 of them, of discussing a possible joint action plan which could involve the temporary suspending of the budget deficit and debt caps contained in this Stability and Growth Pact. If they were to do that, that would certainly then open the door to allow them to come out and spend a bit more. However, Germany, being Germany as things currently stand, is still intimating that it's not keen on this idea. It doesn't like anything to do with the deficit. But Italy, where we've got I think more than 2,500 confirmed cases of this virus now, and is a major hotspot in Europe. They've come out and announced on Sunday, at least proposed, a fiscal stimulus package just off their own bat, worth 3.6 billion euros. That's about 0.2% of GDP, and that's going to include tax credits for companies which report a big drop in revenues due to the impact of the virus, as well as some tax cuts and additional money for the health system. Now, that package has got to be approved, though, by the European Union as well as the local government. Of course, and they can't get Germany on their side. There's no guarantee they'll get it through.
Well, if you think about it, 2 weeks away, March 16th, that's pretty far away. If the markets stabilize, that's wonderful. But if the markets don't stabilize, and they're not stabilized today, they might have more immediate efforts might have to emerge. And does everyone agree that the ECB is the missing link here? That they're the one? If there is to be a big move, it's going to have to be from them.
I think it'd be nice if they were to do it, but the question is, what can they do? So, the old monetary toolbox, as far as the ECB concerned, is almost empty now. I mean, as I understand, the current talk is it's unlikely that Lagarde, even if she wanted it, will be able to ram through a cut in interest rates because Germany doesn't want it, Austria doesn't want it, a number of others don't as well. There seems to be a general wall against any kind of increase in the quantitative easing, the €20 billion a month net asset package as well. All they've got left, well, I say all they've got left, there is talk now that they might start trying to play around with these so-called targeted longer-term repo operations. And this is essentially cheap loans to the banking sector. But again, that's just supplying liquidity to a banking sector, which, at least as things currently stand, doesn't really need any additional liquidity in the first place.
How about direct buying in the stock market?
Well, that would be something which would be completely off the wall as far as the ECB is concerned. It has been discussed in the past, certainly, and it may well be that if this thing really escalates into something nasty, I mean, was it just yesterday where it was the OECD were admitting that it's not impossible we could see a contraction in global GDP in the first quarter as a result of this virus. If that happens, then I think central banks and governments are going to have to start looking at doing something else. And it may be, as you say, intervention in the stock market per se.
But I think also the situation is similar for Japan. They don't have that much room to do more on monetary policy front end. Yeah. So it's going to be a bigger focus, I think, on fiscal. Particularly, they've got to try and do everything they can do to make sure that the Tokyo Olympics go ahead. So we're going to see that, I think, a really big focus. But I think you're right, Mark. Mid-March is still quite a lot. It still feels a long way away from now. And so, in the meantime, there's just, what's striking is just how much focus there is now on whatever sort of daily indications we can get out of China about whether there is actually some sort of recovery from that free fall in activity in February. And so, you're seeing people monitor things like traffic congestion, daily coal consumption, property sales, just to try and get an indication of whether, China is getting back to work. At the moment, there's some sort of signs of stabilization, but not a really sharp rebound yet.
Well, the BOJ has been buying stocks over the last several years. Is that right?
Yeah, that's been part of sort of just their broader quantitative easing mechanism. So, but
they could focus on that, and the BOJ isn't completely without any options.
Yeah, that's right. But I'm just saying, I do think it's going to be a bigger focus on fiscal.
Yeah.
Okay. Well, things will be difficult. I think one of the interesting aspects, I think, of all this is looking at the performance of the dollar. The last few weeks we've been talking about safe haven assets, and within the currency markets, the dollar always tends to do well during times of problems such as now. But it's interesting just how well the euro's rallied against the dollar over the course of the last week or so, and that's really been built purely just around ever since Jerome Powell made his dovish sounds at the back end of last week. And the dollar's really come off on that very sharply, which I guess on a short-term basis still kind of intimates that interest rate differentials remain important to the currency markets. Because for the euro, because we've had these negative interest rates for so long, it's very much been as used as a funding currency for investors to try and find yield elsewhere. So investors have been borrowing euros, investing in particular in the dollar on the grounds that the interest rate differential makes it an attractive purchase. But with this 50 basis point cut, okay, you still have positive interest rates, but the differential isn't what it used to be. And we've certainly seen some unwinding of those carry trades as a result of that. And that certainly hit the dollar quite significantly. So it'll be interesting to see whether or not we get back, if this virus continues to escalate as it appears it will do, whether or not the dollar, reattains its safe haven status, or this interest rate play continues to go on.
It looks like the yen's safe haven status has also been confirmed or is also growing. It seems to be on the rallying too.
Yeah. Okay. Right. Well, what about before we finish on this little lot? Mr. Pender, I have to ask you, does it matter anymore? Friday, we have an employment report. Does it matter? Please tell me that's something we know what we're talking about ostensibly.
The regular things do matter. No, well, that's what I was saying about the employment. And you had, was it the Eurozone unemployment rate was 7.4? Was that today?
It was. We actually saw the unemployment going up a little bit, which is the first time we've seen that really for a while. And just may intimate that, the labour market here, like your side's held up very well, but perhaps it's starting to turn. Yeah.
Well, we haven't seen that turn yet. But if we do see the turn, I don't. That would be even more unsettling, I would think. But the indications going into this employment report have been they haven't been as strong as they were the month before when payrolls jumped 225,000, far beyond what anyone expected. They're likely. I think the economy consensus is 175, which is a perfectly respectable, very strong showing. If there is some kind of a breakdown, it would be immediately blamed. Whether there's evidence or not, just its correlation in time, they would blame it on virus effects, and of course that could raise more concerns about that. But I am, I'm waiting to see in the hard data some kind of a strong reaction. The PMIs outside of China held up pretty well, don't you think, you guys? I mean, for February.
Yeah, across the rest of Asia, they came off a little bit, but you're right, not as anywhere near as sharp as the drop in China. Maybe that means that it just takes a while for those supply chain effects to pass through into manufacturing sectors elsewhere in the region. We've sort of got to wait another 25, 26 days to find out about that. But I think we haven't seen the end of the impact.
And who's going to hold up the stock market over the next 25, 26 days, right? Is it good?
Yeah, it's not an easy time, is it? Well, I suppose there's still scope for some other central banks to do their little bit. Whether it makes any difference or not remains to be seen. But I guess since we've been talking for a while, unless anybody else has anything to add? No? Okay, in which case, yeah, okay, that's great. Well, let's round it off for now then. So central banks have at least started to ease in response to the virus, and if financial markets have got it right, for some at least, and that's including the Fed, there's more to come. The ECB may not be in that group, but we'll find out what they think next week. In the interim, from Mark, Brian and myself, thanks as always very much for listening. Do keep watching Econoday's global economic calendar for updates on all the important data and events. I'm off now to find a virology class, but we'll all see you next time. Bye for now.